Hello, friends. Over the past year, retirees have been hit with two totally different messages. One says property taxes are crushing seniors out of their homes. The other says Congress just handed homeowners over 60 some of the biggest tax breaks in years. Both are true, and today I'm going to walk you through exactly what changed, who actually qualifies, and the two mistakes that are costing seniors thousands of dollars they didn't have to lose. In July of 2025, Congress passed a sweeping tax package called the One Big Beautiful Bill Act. It's already law. This isn't a proposal sitting in committee somewhere. And a big chunk of it directly touches homeowners, especially those of you 65 and older. If you're 60 to 64, some of this still affects your household, even if it doesn't apply to you personally yet. So stick with me because I'll walk through exactly where those age lines fall. Starting with the 2025 tax year and running through 2028, if you're 65 or older, you can claim an extra $6,000 deduction on top of your regular standard deduction, and on top of the additional deduction seniors already got for being 65 plus. If you're married and both of you are 65 or older, that's $12,000 combined. This is separate from Social Security, separate from your pension, and here's the detail that trips people up. You don't need to itemize to get it. Even if you take the standard deduction, like most retirees do, you still qualify. The deduction starts phasing out once your modified adjusted gross income crosses $75,000 for single filers or $150,000 for married couples filing jointly. It doesn't disappear all at once. It shrinks gradually, about 6% for every dollar over the threshold, until it phases out completely at $175,000 single or $250,000 married. So if your income is comfortably under those numbers, you're getting the full benefit without lifting a finger beyond checking a box on your return. This is not a homeowner specific deduction. You get it whether you own your home, rent an apartment, or live with your kids. It's tied to your age and your income, not your address. So if a headline told you this was a special new break for homeowners, that's a stretch. What it actually does is put more cash back in the pockets of seniors generally, which for many of you means more breathing room to cover the very real costs that do come specifically from owning a home. The SALT deduction, that's state and local tax, and it covers property taxes plus either state income or sales tax, used to be capped at just $10,000 no matter how high your property taxes actually were. For a lot of retirees in states like New York, New Jersey, Illinois, and California, that cap meant you were paying property taxes well above what you could actually deduct. Congress raised that cap to $40,000 for tax years 2025 through 2029, with small annual increases built in. For 2026, it's actually $40,400. If you itemize and your property taxes have been eating you alive, this is the change that could put real money back in your pocket at tax time, potentially thousands of dollars depending on your state and your tax bracket. Quick reminder before we go further, if this kind of breakdown is useful to you, hitting like helps this reach other retirees trying to sort through the same confusion, and subscribing means you won't miss the state level updates I cover as they roll out, because several of those matter just as much as what's happening in Washington. A lot of seniors hear SALT cap went up and assume it automatically helps them. It doesn't, not unless you itemize. If you take the standard deduction, which now includes that new $6,000 senior bonus we just talked about, the SALT cap increase is irrelevant to you. So here's the real math you need to do this tax season. Add up your property taxes, your state income or sales tax, your mortgage interest, and your charitable giving. If that total itemized amount is higher than your standard deduction plus your senior bonus, itemizing wins. If it's lower, take the standard deduction and don't bother chasing the SALT benefit. This one calculation alone determines which of these new plans actually applies to you. There are two more pieces from this same law worth knowing if you're carrying a mortgage or a home equity line of credit into retirement. The mortgage interest deduction cap, which was set to expire and jump back up to $1 million, has instead been made permanent at $750,000. That mostly matters if you have a larger loan balance, but it removes the uncertainty that was hanging over refinancing decisions. And if you have a HELOC, listen carefully here, because this is where people get burned. Interest on a home equity line is only deductible now if the money was used to buy, build, or substantially improve your home. If you tapped a HELOC to consolidate debt, help a grandchild with tuition, or cover medical bills, that interest is not deductible anymore. I've talked to more than a few retirees who assumed all their HELOC interest still counted, and it simply doesn't under the current rules. Private mortgage insurance, or PMI, is now treated as deductible mortgage interest starting with the 2026 tax year, which means it shows up on returns you file in 2027. That phases out once your adjusted gross income crosses $100,000. If you refinance later in life with less than 20% equity and you're still paying PMI, that's a deduction you may not have had available to you before. Now, separate from all of this federal activity, there's a wave of state level action that gets confused with the federal changes. So let me draw a clear line. What Congress passed applies nationwide. What I'm about to describe varies by state, and some of it isn't law yet at all. It's still in the proposal stage. In New York, a new law now lets local governments raise the senior property tax exemption up to 65% of a home's assessed value, up from 50% starting with the 2026 tax year now, but individual counties and towns still have to opt in, and income limits apply locally. In Texas, there's a proposal nicknamed Operation Double Nickel that would lower the age for certain property tax benefits from 65 down to 55, but as of now, it has not been enacted. And in California, there's a ballot initiative that would exempt certain homeowners 60 and older from property tax increases. It's still collecting signatures as of this recording, with a deadline in August 2026. And even if it qualifies, voters would need to approve it. None of these are guaranteed, and none of them are federal law. So if you've seen a video or a headline implying Congress passed something specifically for homeowners over 60, what's likely happening is these state stories are getting blended with the federal OBBBA changes we just walked through. The IRS doesn't automatically know you're 65. The county assessor doesn't automatically apply a senior exemption just because you had a birthday, and your tax software won't necessarily flag every box you're eligible to check unless you tell it your correct filing status and age. Nationally, a striking number of eligible seniors never apply for exemptions or credits they legally qualify for, simply because nobody told them the benefit existed or how to claim it. So the real risk here isn't that Congress didn't do enough, it's that these benefits sit unclaimed because the paperwork isn't automatic. If you've been filing the same way for the last 5 years out of habit, this is the year to actually run the numbers again, because the rules underneath you changed even if your routine didn't. What's confirmed? The One Big Beautiful Bill Act, already signed into law, gives seniors 65 and older a new $6,000 or $12,000 for married couples, bonus deduction through 2028, raises the SALT cap to $40,400 for 2026, locks the mortgage interest deduction at $750,000 permanently, tightens HELOC interest rules to home improvement use only, and adds a PMI deduction starting in the 2026 tax year. What's still developing? Several state-level property tax proposals for homeowners in their late 50s and 60s that have not yet become law and shouldn't be treated as guaranteed. The single most important takeaway is this: whether these changes actually save you money depends entirely on your specific numbers, your state, and whether you itemize or take the standard deduction. So a blanket headline can't tell you what applies to your household. The one action to take today: pull out last year's tax return, or better yet, sit down with a tax preparer before the next filing season and specifically ask them to run both the standard deduction with your new senior bonus and the itemized totals side by side so you know which path actually puts more money in your pocket. You've worked hard to build the life you have in retirement, and the tax code shouldn't be something that quietly works against you just because nobody explained the fine print. Take this information, use it to ask the right questions, and make sure the benefits you've earned actually make it into your hands. Thanks for watching, and I'll see you in the next one.